Hello everybody. Firstly, I'd just like to welcome you to this webinar where we'll be talking about the Federal Reserve's interest rate decision and the potential trading opportunities that will come about as a result. My name is Sasha and I'm a financial analyst from the research department at Fortrade. I'm really pleased that you're watching our webinars. If you have any questions, I will do my best to answer them, or please call us and ask to speak to a senior account manager who will be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. Now, first off, we'd like to introduce you to what we call a market opportunity. A market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple to understand opportunity to trade on the markets. We will select an instrument such as gold or a currency pair and tell you our very best estimate on its price direction so that you can trade on it if you want to. Market opportunities are produced by the research department on a daily basis according to market conditions and based on historical evidence. This can relate to daily trading, weekly trading, or monthly trading. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and support and resistance levels. It's important to understand that it's solely your decision whether you trade on market opportunities or not. So here's an example of a very recent market opportunity, one from last week in actual fact. Here you can see fundamental analysis on what's going on with the euro-dollar currency pair. You can see this is a downtrend opportunity over a weekly period. Since our analysis suggests that the euro would decline in value against the dollar, at the top you can see some geopolitical events and fundamental analysis that can influence the euro-US dollar currency pair. For example, the part on the trade war, stating that the US dollar acts and benefits as a safe haven asset when trade war tensions increase, or the situation in Italy which has affected the euro. When using a market opportunity, it's vital to look at the pivot point on which the calculations are based. In this instance, if the price reaches the 1.16906 level that you can see on the left bottom hand side of the screen, this shows the right moment in our estimation for opening a trading position. You can see on the other side, on the right hand side of the screen, the trend direction and the time period. It's also important that you know how to use the stop loss and take profit options. You have support and resistance levels on the right hand side of the screen too. At these points you can put a stop loss and take profit, and further down you have calculations. If you close the position using take profit, you can expect these kinds of profits at the support levels in green. If the price is going against you, then you can potentially have a loss of this amount at these resistance levels in red. Finally, profit and loss calculations are based on a one-lot trading volume. I hope that's clear. Okay, so what is the Fed and the Federal Open Market Committee? As we know, the Federal Reserve is the central banking system of the United States implementing monetary policy. The current chair of the FOMC and the Fed is Jerome Powell, who replaced Janet Yellen in February 2018. Most analysts agree that Powell continued Yellen's monetary policy, although he has attempted to push for relaxed regulations on financial institutions. The FOMC is crucial since it's the body that makes important decisions on monetary policy by raising or lowering its target for the federal funds rate. That's the interest rate for overnight borrowing between banks that has a great impact on the price of the dollar. So the Fed's monetary policy is a dual one. Its mandate, that is a dual one, to keep inflation below or close to 2% and to create jobs. And it does this via monetary policy that is setting interest rates. You can see here on the table how the Fed has kept interest rates historically low as monetary medicine to kickstart the economy following the financial crisis. But as the US and global economy has strengthened in recent years, you can see how over the past 2 years, rates have increased to today's rate at the end of the graph of 2%. I should also mention that jobs and inflation are also considered important factors when deciding to hike rates or not. So, the previous Fed meeting. The previous Fed meeting took place on August the 1st. The interest rate remained at 2% in line with analysts' expectations. The last interest rate hike of 0.25% took place in June. August's decision took into account improving economic conditions, although Fed officials showed concern about global tensions. However, in a sign of confidence in the US economy, members of the committee raised their economic growth projections for this year, forecasting US economic growth of 2.8% in 2018. Improved economic prospects have led analysts and members of the committee to conclude that 2 further interest rate rises are likely this year. The decision to maintain interest rates was unanimous, and members noted improvement in the jobs market. The Fed signaled, as I just said, that there is likely to be a further 2 rate hikes this year, and the markets reacted as one would expect. By the end of the trading day on August the 1st, the dollar climbed 0.12% against a basket of other currencies. The main reason this happened was the fact that it was implied that there would be those further 2 interest rate hikes I mentioned this year, rather than the previously anticipated 1 further rise. As you can see, it continued to climb in the following days, although this was assisted by the safe haven status of the dollar with increasing trade war tensions. On the other hand, the euro-dollar fell upon the release and was down some 0.08% by the end of the session. The currency pair continued to fall back in the following days for reasons I described. Additionally, while the greenback is due another 2 hikes this year, the euro won't get a hike until the end of summer next year at the earliest. So what can we expect at this meeting? Well, the US Central Bank is widely expected to increase interest rates from their current level of 2% to 2.5% when it meets on August the 26th. Analysts and traders are so confident about this that the current target rate probability from CME Group indicates a 97.5% chance that interest rates will increase from 200 to 225 target range. Investors will also be looking for further clues on whether interest rates will be hiked a further 2 times this year, as the Fed suggested. Despite inflation picking up and improved wage growth, the Fed still thinks it's appropriate to hike rates at a slower pace. Thus far, no major changes in the interpretation of the labor market and its impact on Fed policy under Powell has been made, as he has said that he and the FOMC thinks it's appropriate to continue the current hiking cycle. On the other hand, a slight increase in the pace of interest hikes seems to have the support of most members of the FOMC now. There is a 65% chance, according to CME Group, of another 0.25% interest rate hike in December of this year. So as I stated, traders expect a small interest rate rise this month. This month's Fed interest rate decision comes amid a slightly softening dollar that has weakened over the past month, despite the increase in trade tensions and tit-for-tat tariffs between US and China. The news that China has been selling its holding of US bonds also put some pressure on the dollar recently. China owns more US Treasury bonds than any other country. In any case, investors will be hoping for confirmation of further 2 rate hikes this year. If such information is forthcoming, the value of the dollar could potentially rise. However, any bearish statements or potential downplaying of the chances of a December rate hike would likely push the dollar down. You should bear in mind that since interest rates still remain at historically low levels, economic growth and borrowing is still being encouraged, which usually helps stock prices to rise, as they have been doing recently. However, since President Trump announced tariffs on steel and aluminium, investors are nervous of a trade war, and historically US trade barriers have tended to weaken stocks, as was the case with Presidents Clinton and Obama when they introduced tariffs. Any decision to trade dollar currency pair and stocks should be made with the geopolitical situation in mind, as well as on the direction of interest rates. Well, I hope you found that information useful. Of course, at ForTrade we'll be following developments related to both the Fed decision and what we expect to be a very busy week's trading. Please get in touch with your senior account manager for further information. Until next time, goodbye, and please join us at ForTrade again soon.